Hey, thank you so much for being here. I got to meet a couple people last night. This is their 4th year being here, which is pretty wild. It's also my 4th year, which is exciting that we have that in common with one another. But the point of Fintech DevCon was I felt like there was this big void in financial services where how payments worked, how ledgers worked. How do you do CI/CD with an OCC audit and pull that off in a compliant manner? These are things that aren't individually like the differentiator that our companies and our brands are bringing a service to market. It's kind of like the table stakes or the building blocks for us to serve this industry. And this industry we get to serve is pretty incredible. You know, money touches every single person in a very unique and personal way. And the tools and the products that we get to build affect actual individuals' lives. And so we're excited about that. You know, what do I want from you as an attendee while you're here? I want you to connect with people. So what's unique about this conference is everyone's here to learn first and foremost. And so the people around you are looking to connect and learn from one another. And there's just as much learning happening in the, you know, having a beer with somebody or a coffee as there is listening to the speakers. Second, thank you to the speakers because we had over 200 applications for 42 speaking spots. It's pretty amazing. These are over 200 people that are donating their time and energy in order to put a presentation together to try and educate somebody. Pretty amazing, so make sure you thank them. By design, you can't see every single talk. There's this new website, YouTube, it's really cool, and every single video from the last 3 years and this year is on there. So please, you know, check those things out and make sure, you know, subscribe. I feel like my kids right now. Subscribe and like to our YouTube channel. But make sure you give feedback to those people. And then, you know, my challenge to you is I hope you leave here inspired. I hope you leave here thinking, maybe I can make this industry better. Maybe what I'm doing at work can be more exciting. And hopefully you come out of this thinking, oh, everybody here is trying to figure out, just like me. I know I'm in that same boat. And by having a community of individuals that we can learn from one another, you know, that's why we want to be here. And that's the ethos that we're trying to kind of instill in this conference, is a unique place for you to come, connect with people, get your education on, and hopefully leave inspired. And so let's get started with being inspired. I'm really excited to welcome our first keynote speaker, Simon Taylor. Simon Taylor owns Fintech Brainfood. He's also the head of content and strategy at Sardine. Interesting, if you get his email on Saturday morning, I think it's our brains that are getting fed as food, you know, trying to keep up with this guy. I have no clue how he writes all this stuff every single week and then does everything else he does. But I'm so excited to have partner in crime and friend Simon Taylor kick us off for this first keynote. Simon, welcome up.
Thank you, everybody, for being here, for cutting off your breakfast, and for being up this early to listen to some guy with a British accent that you might never have heard of before. I really appreciate you coming out. My name is Simon Taylor. I do work at Sardine, but I also run Fintech Brainfood. And I wanted to talk to you today about a recent experiment I ran. So I spoke to the CEOs of Ramp, Brex, and Mercury. Not the typical interviews, not the typical podcast. It was much more, what can I learn from them as operators, as product managers, as founders, as engineers? And the reason I write a weekly newsletter is I get fascinated when people tell me something and it just makes me curious. It nourishes my mind. That's why I called it brain food. I can't help myself. I'm addicted. I'm a nerd for this stuff. I once described the fact that people read my newsletter as suddenly waking up and discovering everybody was wildly into my obsession with Dungeons and Dragons as a kid, but it just happened to be about finance and tech. It's like really weird that people got into this stuff, but I love it, and thank you so much for taking the time. So as I said, I'm Simon. I write Fintech Brainfood, and I do content things at Sardine, and Sardine are really awesome. You should check them out. Right, so why did Ramp, Brex, and Mercury show up in the first place? Hands up if you ever did expenses without Ramp, Brex, or Mercury. OK, so that's only like half of the room. So for the half of the room that's never done this, well, for the half of you that had done expenses before, I'm sorry. You know, but so many in this room don't know how much this sucks. Oh my God. If you've ever worked in it, the fact that you had to print out paper receipts, you were trying to fill in a spreadsheet, you were trying to tap them into, have you seen that app? Look at it. Who ever allowed that to go out? SAP, the company that builds Concur, is a $224 billion market cap business. Now, granted, that's only one of their product lines, but it is horrific. Enterprise software had been utterly horrific. And yet, there are now a generation of enterprise-scale companies that never used SAP Concur. You might have heard of a company called DoorDash. You might have heard of companies like Twitter. There are some really big, I refuse to call it X, there are some really big companies at scale out there that have never used these classic products that are really, really massive. So B2B Fintech fundamentally is serving an entire different generation of companies that they've grown up with, that they were the default supplier for. And they're moving beyond, oh, this is a really nice, this category gets called spend management. But they're moving beyond spend management, and they're moving into everything enterprise ERP ever did, but doing it with taste, with quality, with panache. And that's what I wanted to unpack in this talk today. So why do they have so much momentum? Well, I think, number one, the regulatory burden is generally much lower than consumer products. If I'm in B2B Fintech, I can just execute, and I'm not worried about the CFPB or consumer regulators or the OCC coming to scare the living daylights out of me. And I don't know if you've noticed, but there's some stuff going on with regulators at the moment. So we'll come more to that lately. And historically, like these growth companies, especially VC-backed software companies, would receive $10 million Series A check, but they'd get a checking account, a commercial banking account that looked like a mom and pop store would get. It was just fundamental mismatch in requirement versus product. And of course, then don't forget our good friend interchange. Swipe fees on corporate cards are typically higher than consumer cards. So you put all of that together, my compliance burden is lower. I've got this massively underserved segment, and also I make more money per swipe. Why wouldn't everybody do this? In fact, that's kind of exactly what the CEO of Ramp, Eric Gleiman, said to me when he was thinking about founding the company. He'd worked at Capital One, he'd seen how hard consumer business was, and he said, oh, I can just go over there. I can win much easier. Smart man. So meet the big three, Ramp, Brex, and Mercury. I spoke to the CEOs of all, and they started in a slightly different place. So Ramp starts with spend management, Brex starts with spend management, but where they've expanded is a little bit different. Ramp has gone into your bill pay, your invoice, procurement, and travel. Brex is going more enterprise. It's going more procurement, treasury, accounts payable, but they're kind of getting into the same place. Their tech partner approach, and I'll double click on these later on, is fundamentally different. And this is what makes them really, really interesting. Ramp is like partner on everything that doesn't touch a customer. Brex is how much can we vertically integrate? And you see that play out in their ideal customer profile and how they're expanding their business. And then Mercury is sort of halfway between the two, but they started not with expenses, but with this like operating account that just works. And then they're layering on the spend management. So they're all speed running towards the same sort of SAP plus bank account endpoint, but they're doing it slightly different. And they all think that their differentiator is different, their approach to shipping is different, and that impacts their geo focus. I will go into more on all of these, but I just wanted to give you that summary. So What's the same? Aside from the fact that they're all dudes, each founder has an appreciation for engineering. There are very few incumbents I can say that for. Possibly Capital One. Richard Fairbank is a different cat. But with that exception, I can't think of many that had a real deep appreciation for engineering or were engineers. They all consistently invest in technology as their differentiator. They all, every single one of them, told me how support tickets were driving their roadmap. Again, that is probably a default for a lot of folks in this room, but it's just really, really different from incumbents. Every one of the CEOs was obsessed with talking to customers and had a deep understanding of their tech. And for what it's worth, I liked all of them for different reasons. They're quite affable. They were very, very capable at being human, which I clearly am not. So Ramp is built different. They're a generational company. And when I spoke to Eric, he said something that really stuck with me. He described the company equation. What is the company equation? Well, famously, SpaceX, if you've heard of that organization, measures the dollars per kilogram in space. And then everything they do works back from that equation. So Ramp, similarly, measures the number of hours they've saved their customers in work or effort, and they measure the dollars they've saved in costs. So today they save companies on average 5% of cost and thousands of hours. But here's the thing. In terms of their internal KPIs, they don't necessarily set just a pure revenue target, because their revenue is doing absolutely fine. What they're setting is targets around the inputs that create revenue as an output. But more importantly, they're setting targets around the inputs that create hours saved and costs saved, because that is their company equation. And I was like, blah. That level of clarity is incredibly difficult. Wade said something very kind to me yesterday. Simon, you're very good at simplifying things. I cannot turn a company into a company equation that elegant. That's E equals MC squared level stuff. That is really, really hard to do, and yet it creates this really interesting North Star. So another thing that drives them is velocity. There are blitzscalers. There are people that take the more Apple approach. How many of you have been to days.ramp.com? If you've not, check it out. It's just a live ticker of the number of seconds and days that they've been in existence. It's a really interesting North Star. They hold it up in the background on all of their company offsites. It's like, it feels really passive-aggressive, and yet in every interaction with anybody from there, it doesn't feel like that weird, like overly bro culture, overly aggressive culture. They found that balance in quite an interesting way. There's a lot of companies that I meet that have that velocity shipping culture, and I'm like, I could never work there. I'm a dad, I got 2 kids, I got stuff to do. Like, duh. Not so with Ramp. That was quite nice. But it creates an interesting problem, though. If you ship so fast, it becomes very hard to ever describe what you do. So they tend to just start with a small piece and kind of build from there. So buy, build, or partner. So Eric listed a few of his partners, but he noted, Stripe, Marketer, and countless others in the interview. But he said really what that allows him to do is obsess over the front end. Like, he is not worried about the type of stuff that Wade really loves and I really love. He lets somebody else sort of deal with that because he's really focused on the front end. And he has to be able to trust his partners to do that, and does occasionally change them over. And the questions he's constantly asking is, how could this be faster? How could this be more efficient? What else could we do? What if it worked with Slack? Should it work with personal emails too? What if? And again, that could be kind of intense, but it's an interesting model and way of thinking about things. So I asked as well how he does the engineering structure. And of course, it's not novel that somebody has an infrastructure team and product teams. Like, that's a fairly well-known model. But what they're really doing is bifurcating the two from the very genesis of the company. I think a lot of people would like to go back into their tech stack and just start again. But the fact that they've got so many partners means that the partners handle a lot of the issue, and then what the infrastructure team is doing is quite lightweight and really, really, really focused. So that is a model that works if your goal is to serve an end customer and your differentiator is user experience. It is an objectively smart strategy for them and what they're trying to do. It's not the right answer for everybody. It's just a very interesting answer for them. And I think, again, having a CEO who thinks in terms of the company equation, it really does allow their KPIs throughout the organization to maintain an interesting hold on it. So, some observations. The obsession over speed bumps. I made this slide originally because I have like a whole side hustle of taking screenshots of ramp and showing it to bankers whose minds get blown of like, oh my God, I didn't know that was possible. And I'm like, yes, because you've never used the product. So I once DM'd Eric and mentioned, oh, you know, that feature you've got, you have the ability to forward receipts that come to somebody's personal email to receipts@ramp.com, right? But it doesn't work for me. I think it was like less than 20 minutes later, I get a response. Oh, yeah, sorry about that. Your personal email was configured against a different business. That's now fixed. It'll work now. From the CEO of a company. Now, granted, I'm some British guy with a blog. Maybe I got a faster response. But I don't think it's just that. Name another CEO that's true for. Or maybe Soups. Soups is built different too. But it's that kind of thing that I think actually has allowed them to differentiate. Another feature I like is this make recurring button. You might get a ChatGPT subscription or something along those lines, and if you don't want to fill in like a receipt memo every week, just hit that button, it goes away. Little details that are actually incredibly hard to execute as products underneath. The amount of work that will have gone into something like that is phenomenal, and don't think for a second I don't know how hard this stuff is. So it's delivering results. Their total purchase volume is doubling every single year. It's kind of nuts. I got this picture from Packy McCormick's Not Boring, who does a great breakdown of them. They take 10 times more money home. So they make 10 times more money than they did in March 2022. So that's what, like 25, 26 months? Unbelievable. Ramp by name, ramp by nature. It's ridiculous. So they've got the right product, right time. They've really hit it right. They are a generational company, and I think they'll do incredibly well. However, maybe it could go wrong. You know, they are domestic only. And Eric even said there's just almost no incentive for them to go global or international. They're just no. So if Ramp is Stripe, and I think of Stripe as being like really great at the front end, opinionated at the back end, you know, you're not going to be able to configure it the way you want. And Adyen's the other one. It's like, we'll take you global, we'll work with big enterprises, we'll go everywhere you want to go. They've got more of a global coverage. Ramp is going to be stuck in the US. Not a bad place to be stuck, to be fair, but maybe somebody else like Brex could win a bigger opportunity elsewhere. What does Eric worry about most? Talent. Love it when somebody says that. I asked him, what do you worry about? And he said, will this be the place everybody wants to work in the age of shiny, new AI toys and ridiculous VC funding for going to build an AI thing? What's interesting is how many people have left Ramp to go found a thing that then comes back into the organization with that as a feature. It's almost like weird R&D cycle they've got. And Eric's really, actually nice. Maybe I'm just naive, but like, I actually like the guy. So Brex is led very much by an engineer with opinions. But I really, really liked Pedro. If you listen to this interview, the first couple of minutes, he's talking about his conversion from Vim to Emacs. He described running the business as being much more Apple-like. He is the arbiter of the roadmap. There is a delivery once every 3 months. He signs off every single feature release himself, and everything is built to those major releases. And you have to wonder, why? Well, go back to the history of the organization. When they were building Brex, a lot of the issuing stuff and a lot of the banking as a service stuff, Stripe issuing and all of that didn't exist. It wasn't possible to do it. Look at when they were founded. They were just a little bit earlier, and they were the best answer at the time. So they had a first mover advantage but also, is it a disadvantage? They were sort of the default for companies of that generation, because all expenses sucked, and Brex was the best game in town from a user experience. Remember, founders of VC-backed companies had to get a credit card on a personal credit line, even though they had 10 million sitting in a bank. It was crazy. So Brex created this category, but no infrastructure existed, so they had to build it in-house. They had to go vertically integrated. And the vertical integration now is actually giving them this interesting strategic positioning. They might not win the velocity game, so why not go the other way? Why not build in-house? Bring processing in-house. Partner more directly with banks and schemes. That enables you, if you build it right, to move into new markets faster, like DoorDash. They're live in 27 markets with their 16,000 staff, because going national is hard, going international, a whole different level of hard. So where Brex is going is fundamentally different. They're going up market to these global growth enterprises with the cohort that they had. And that's not wrong, it's just not Ramp. And that's really interesting, because everybody positions Ramp versus Brex, and ooh, who's gonna duke it out? Doesn't matter. They can both win. And one has this culture, the other has another. And they've done pretty well. Like, they hit, what, 319 million in net annualized revenue in 2023. That's a lot of revenue. And a big old increase. But a lot of this, of course, is driven by the 302% year-on-year growth of revenue from deposits. Rising rates lifts all fintech. The banks have done really, really well. They're announcing some of their best dividends ever. But fintech companies are also doing really well, which people didn't expect. But also, what if rates come down? I think we could still be in a very interesting place in a couple of years' time if those rates do come down. So engineers aren't always the best designers. No offense, but I do think there's a risk of some of that customer churn. There's not the big, massive customers churning out of Brex, but some have gone to Ramp or to Mercury and elsewhere, especially the smaller end. It's really interesting to me how Brex have lived long enough to see themselves become the villain. The social media stuff has become a bit angsty, and I think marketing and PR could be kind of one of their interesting challenges. They're not the cool kid anymore, and that means you're not winning the growth company. But if Brex is Adyen, and they're trying to go international, and they're trying to go enterprise, Adyen's a great business. It's not a bad place to be. And last but not least, Mercury is led by the founder's founder. Imad is obsessed with user experience for founders. He's just fundamentally that way inclined. So I think he's got 300 angel investments. He was an angel in Airtable, Substack, Rappi. And he said the worst thing about being a founder was dealing with the banking and admin headaches. And I can tell you, as somebody in the UK that doesn't have any of these products, with a little side hustle business, it's horrific. So he just focused entirely on user experience, with more than 50% of customers being referrals. And this is something you see with Ramp, it's something you see with a lot of neobanks that's not true. If you get the UX side of it right, the referrals reduce your cost of acquisition. And how can you get that referral flywheel really humming for you? It has to be really on the shop window. And what's interesting about this is they all have different approaches to how they manage their technology stack, but they all initially got their wedge customer, their first customers from user experience. So if Ramp is functional and zero friction, Mercury is focused on being just beautiful. Every button, every pixel, everything is agonized over in a way that is just rare. It's the #1 requested feature by Mercury customers was personal accounts. I think there's this general perception that user experience is like a nice to have and look and feel and da-da-da-da-da. And people really discount how much of a massive, massive differentiator it is, how much of a difference it makes to your business model, how much it drives customer acquisition. Customers love the product in a way you just don't hear about for anything else. People are like relieved by Ramp. Oh, God, it worked. People love Mercury. They love it. It's kind of a weird obsessive thing, actually. So they mostly partner. You might have heard that they were an early mover. They partnered with a company called Synapse and Evolve. Just going to leave that there. Jason McCullough is in the room. That's all I'm going to say. Just going to back away from that one. Today they've moved on. Today they use Lithic for issuer processing and multiple banks. That is what I learned from that conversation. And they see themselves as the account becoming a platform to run hundreds of other business workflows from. I think ultimately all of these companies are becoming a bank plus SAP. They're becoming the ERP in the bank. They're going that way. That's really, really interesting. Here's another one. All of their UIs for their support teams, they built those in-house. That's the only other company I can think of that's done that is Monzo. So they would go to API providers for infrastructure like fraud and compliance and customer service, and then they build their own UIs over the top of it because they want their customer support agents to have great user experience. They're obsessed. And they've hit 8 quarters of profit. They've more cash on their balance sheet than they've raised. They've 200,000 customers, 640 staff. But most of their revenue growth has come from deposits. So these businesses are having a great time, as are the consumer neobanks. But once the interest rates come down, then what? Then what? I think that's a really interesting question. So the bear case is Synapse and Evolve probably felt like a good idea to an engineer that had never worked in fintech before, like 4 or 5 years ago, but maybe not so much. And partner risk is non-trivial. Imad's vibe is like he's unbothered, he's moisturized, happy, he's in his lane, flourishing. But under the hood, like when I was trying to set up this conversation, you can tell there's like a, ooh, you know, this is difficult. And that partner risk is real. And so the problem with selecting partners is that partner risk can really impact you in a high-value buyer segment. But most of their customers, remember, we live in an echo chamber. Most of their customers have no idea this is happening. Most of their customers will never see any of that stuff. And so they're still growing. They're still doing absolutely fine. But again, what happens when rates go down? Whose share, what goes up will also come down. So will this category ultimately eat all of the things? Will everybody be B2B fintech? Or is there actually some meaningful threat to them, some AI-driven laser beams thing that's going to come and wipe these companies out? Competitors. In my day, Ramp was cool. Younger competitors may become a threat. One day you wake up and you're the old guy. Seriously, have you used PayPal lately? It's just, ugh, what is this? So that's always a risk. I think this is, you know, Stripe's risk and Adyen's risk from companies like Moov. Like, the payments moves in generations, and I think consumer and business brands will move in generations. The old ones don't die, they just erode market share. The younger ones come up and take the new market. So what happens if incumbent banks get their act together? Just going to leave that there. The best thing incumbent banks can do is partner. And I think actually some have really started to do it. So I think Navan partnered with Citi, JP Morgan's partnered with Gusto. There's some smart partnerships going on there. And actually that's non-trivial because the threat then becomes sort of that partnership model can take meaningful market share and do a different thing. And serving enterprise is really, really, really hard. Once you get above sort of like serving that Series C company, whew, the requirements, the procurement, everything gets 10 times harder. I mean, it's possible. It's entirely possible that regulators kill banking as a service and non-bank activity. I don't think they're going to actually kill it. I don't think this is an existential threat. These are dream clients for the banks, and there are a lot of banks that are not in the headlines quietly moving forward with embedded finance, especially some of the larger ones. The things that you don't hear about are you hear about the companies exiting some of the sponsor banks that are under consent orders, and if they're under a consent order, they can't win new business. But what you don't hear so much about is the hundreds of small banks trying to get into embedded finance, and the very large ones waiting with open arms, able to take their time, able to do their due diligence, and cherry pick the best customers. So this will all continue to exist. It will all be absolutely fine. And these are dream clients. Like if I work in cash management or the transaction banking division or the trade and working capital division of a big bank, and Mercury, Ramp wants to bring all of their volume and all of their deposits to me, that sounds lovely. I'll have that. Thank you very much. So these brands will be absolutely fine. They might get a slap on the wrist from regulators. They might be fine. But there's a real flight to quality taking place. So I think we should kind of ignore the noise. We need to get out of this bubble a little bit of like, all of this stuff's happening. Because it is incredible how poorly some of the early programs were configured. I was at dinner last night, and people were like, this was always going to go wrong. But every generation has a bunch of people. Wade's lived through a couple of cycles of fintech. I've seen a few myself. Sam Moll was here with the dinosaurs. Love you, Sam. But it happens every generation. Technology person that doesn't know finance gets into it, figures out regulation is hard, gets better. That will happen here as well. There's now this really interesting crowd, all of the people in this room, who are engineers by default and fintech by default that really get finance, really get compliance, really get risk. And that's really, really exciting. I think all of these companies are gonna be worth 10+ billion in the post-fintech bubble world. In like Darwin has returned to tech valuations world, they're still massive enterprises. There's not an existential threat to these businesses. Great companies succeed with regulation. Without regulation, they're great businesses. They're going to be absolutely fine, and constraints happen. Talk to any founder of any business, and there's like 100 constraints every single day. So this is, I think, the takeaway for the audience. There is no right way to execute. There's no right way to engineer a product. There's just what works for the founder and the company they build. Every founder is built different, so every company is built different, and they implant that DNA. Each has this mechanism to maintain visibility and alignment across the company. For Eric, it's metrics, the company equation. What are my inputs? He can go have a conversation with the sales team about, like, how many meetings were you able to book this week? Did you get enough support to book those meetings? Because he knows those are the inputs he needs to get them to create revenue. He can talk to product teams about how many speed bumps were we able to solve? What are your constraints? How can I help you go faster? For Pedro, it's the roadmap. Are my clients talking about these things? Okay, can I deliver against these things? Are we running to a drumbeat? He's like the metronome. He's much more that way. And for Imad, it's user experience. Is it beautiful? Can I feel it? Can I touch it? They all have these different signals. How many of you have worked in a bank? Okay, so about 30% of the room. You will probably resonate with how wildly different this all feels from how banks ship products, and that's a competitive advantage. Only Imad mentioned a committee, and that was for design. I think you can get your compliance right without just filling up the world with committees. I think these businesses will get there. We will need regulatory clarity for that, but it is wildly different. And I think we can learn lessons on both sides. The financial institutions in the United States that are of a larger scale have to go slow. They have to come correct on compliance, but they could learn these execution lessons. But they could also help really package the compliance stuff in a way that's more thoughtful and more accessible to an engineering or a design audience. The fact that these companies are not banks is an advantage in the short term. It helps them deliver products faster, but you've got to wonder how long it will be before they take meaningful market share from incumbents rather than just filling a hole left by SVP. So that was all I had for the presentation. I'm going to point out we do have some microphones and some runners in the audience. So if you could show your hands if you're available, one at the back here, one in the middle back here. If you have any questions, let me know. But thank you very much for listening to my TED Talk. Loving the dual walking microphones. It looks like two walking statues of liberty. It's phenomenal.
Yeah, so Simon called me a dinosaur, so I can't stand you sometimes. I love you, Simon. So you named the ones that, Ramp and Brex and Mercury. Want to name some you see up and coming?
Yeah, so I also spoke to a couple of others. Meow was interesting. I think that's all I can say, really. I liked Arc, actually. Arc, their opening was, we see compliance as a competitive advantage. We take our time. Yes, we're a Series A company trying to grow, but we think there's space to be the people who get compliance right. They're also doing a lot of the harder products to do. So they're doing debt financing, debt capital markets. They're doing a marketplace for that. So that if you're familiar with Finley CMS, so if you were a lender, for instance, you need to go get a supply of capital to be able to lend it because you're not a bank. Finley CMS is a platform that enables you to sort of do that. Well, Arc is moving into sort of that territory where they'll help you meet with and match with private credit funds, with banks, to be able to fund your lending business and your lending activity. So they look a lot more like the sweet spot of a Silicon Valley bank historically. And you see Mercury starting to go there, but that was an interesting strategy. It gets really nerdy when you get into the finance side of the fin bit of fintech. But actually, I think there's space for people that really get engineering, that get product, that get design, but that also get like old school Wall Street finance. And that's probably the missing gap in the market as of yet. Hey, what would be awesome? The Statue of Liberty's back. Question over here.
So the first one is why are there so few people in the United States who share the name Simon? I don't have an answer to that. But most importantly, so you highlight Brex, Mercury, and Ramp, and they've all done really well with self-issued cards. For example, Ramp does a lot of volume with Marqeta. In my estimation, at some point, they saturate the available market for self-issued cards. And if they want to move up market and really compete with Concur, what do they need to do in order to find those businesses that have got the Citi-issued card or the JPM card and get them on the platform?
The Citi-issued card and the JPM card is usually a cross-sell, or it's very rarely the product you have by itself. It's the product you get as a bundled package with everything else, and the everything else is a really large credit line. It's really good deposits. It's really good FX. It's this package offering that a bank would give you. And so they can be really competitive on pricing because they've got returns to scale, but also they've got that product depth, but they'll only give you that pricing if you take everything. So this comes back to like one of my very, very early slides, which is, I think they are, I broke it, never mind. I'll just leave you with that. That they're speed running into accounts payable, accounts receivable, and then from there they're getting into venture debt, and from there they're getting into working capital, revenue-based financing. So they're bringing in that sort of stuff and those sorts of capabilities. They're enabling deposits. The competitive side on the bank really makes sense. But if they can get those workflows from the accounts receivable and the accounts payable for the CFO stack, and they can make those enterprise grade, that's where the international, where the Brex really comes in. Because once I go international, now I've got a corporate structure and a corporate hierarchy where I've got 25, 26 different entities in every different country. And I need to do transfer pricing between each of these entities. And not only that, it needs to all add up at the end of the day, and I need to maybe report that on a quarterly basis as a publicly traded company. And so the reason somebody buys SAP is because it can do all of those things. It does them ugly, but it can do all of them. And these guys can't do all of them. So they have to go up from the sort of product depth and expansion into the workflows. Does that make sense? All right, I think I've got time for one more, and then I'm out of your way. The one at the back there? Statue of Liberty is running. I like this.
Hello. What do you think are the top 3 challenges or concerns in the fintech space?
Top 3 challenges or concerns in the fintech space. So if we set aside the challenges and concerns of every growth business for a second, which is just normal, I think the number one is kind of the funding market and the market headwinds and tailwinds, right? Fintech went from 1 in 5 VC dollars to less than 5% of funding. The amount of bad news in boardrooms is phenomenal. There is existential risk. There are companies on fire sale. And what I'm really seeing, and I'm sure a lot of you are seeing this too, is this power law of fintech companies. There are those like Ramp that are doing extremely well. Thankfully, where I work is one of those. And then there's sort of this long tail of companies doing quite well, and then, whoa, a lot of things that got funded in 2021 that are really, really struggling. So what are all of those people going to do that work at all of those companies? I think that's an opportunity for incumbents, and I am starting to see a lot of very talented people go work at an FIS, go work at a Jack Henry, go work at a... I think that's one thing we'll see. So what happens with the talent is my biggest concern, and it's always the thing I think of first. I think the second biggest thing is what happens after the election, honestly, because depending which color you get after the election, you might have 2 very different regulatory environments for fintech. To Democrats, fintech just sounds like risk, and to Republicans, who knows? I don't want to get too political, but that's kind of, I think, a fork in the road. Like, I think it could go kind of either way. And then the third thing is, why wouldn't everybody else be embedding finance? So a lot of the consumer neobanks, a lot of the B2B fintechs, they sort of live inside of Shopify. They live inside of everything else. Like, where's that go? So if you've got a market where fintech is not perceived as AI, and unless you attach AI to it, you can't raise a fund for it, you can't get it your next round funded, oh, it must be ugly, it must be horrendous. You've also got a regulatory question mark. Where's this thing going to go? What's going to happen? You know, it's headline news, the stuff Jason writes about. He was doing it before it was headline news. But it's headline news, and that's a negative PR for the entire industry. And then lastly, on the talent side, what's going to happen with the talent? I think it's choppy waters right now. I really, really do. But from these things, great companies are built. And from rooms like this, from great talent, the fact that you come to a developer conference about finance means that you're going to build something special. And I fundamentally believe that, as Wade was saying, money touches everything. Like, I think it was a lot of money to make this stage, but somebody had to make a payment for it. It's a lot of money for the chair, the desk, everything. Everything that you touch around you, some money moved, and there is an enormous friction in that. Financial services is the world's largest profit pool by far. It's also one of the most inefficient industries by far. It is crying out for great engineers to build great products. And so I hope that's what happens. It will be difficult, but great things are made in harder times. If you look at the companies that have the highest valuations in tech stocks in public markets, and when they were founded, it was usually during the time when that sector was down. So that's my call to arms. Go build great shit.